Thanks a lot for inviting the paper. This is joint work with Patrick Bolton, Howard Rosenthal, and Chris Tausanovitch. Okay, so what is the motivation and the research question that we are looking at? We are studying the evolution of the preferences of institutional investors over the period 2004 to 2018. We are in the process of expanding the time frame to more recent period. And we try to understand also what are the consequences for corporate governance. So what are the preferences of institutional investors like BlackRock, Vanguard, State Street, or the small one, Domini, Some Value Fund? And how do we estimate these preferences? Well, we look at the way they vote in the proxy voting of the companies they own. So, there are various ways of measuring preferences. You could be measuring them by looking at the way the missions that they state, what they are doing, maybe even the way they are investing. And what we're doing is a specific way of measuring their preference, which is how do they actually vote. This is a period in which, in corporate governance, a lot of things are happening, right? There is first the financial crisis. There are the regulatory changes that are brought by the crisis, Dodd-Frank and all the other regulations. It's also a period that witnesses a record, I would say, concentration in the asset under management. So the amount of assets under management for the entire institutional investor group increases, and even within the group, it gets concentrated towards some very big players. It's also we also witness a move toward passive investment that started before but is intensifying in this period, and then of course the rise of ESG. So all these changes, what happens to the preferences of the institutional investors? And so I'm going to tell you how we measure them and what we really mean by preferences. So the first thing is how we measure them. So we use a dynamic spatial model that is borrowed from political science. If you are an economist, you might find this similar to the McFadden random utility models. Basically, the idea is that there are a set of players, of decision makers, agents, that are heterogeneous. We don't know along what dimensions they are heterogeneous, and they pick options on things. In McFadden case, were consumption goods. In our case, are voting yes or no on certain proposals, and these proposals have various characteristics. The investors care about the characteristics, but we don't know, as econometricians, which characteristics they care about. So what we're going to do is we're going to estimate the preferences from the company voters skip, basically. So if the two of us always vote similarly, we are going to everybody, all the investors and all the proposals are going to be represented in a two-dimensional space. If the two of us vote similarly, then we will be closer to each other in that space. If we vote separately, we will be farther away. The advantage of this method is it is completely agnostic about our identity and the topic of the proposals that we are voting on. So it doesn't require any value judgment ex ante about, is this an ESG proposal? Is this a good ESG proposal? Or is this greenwashing or something else? It's just like who acts together get clustered together. This is the idea. And we call ideology, this is the background, we have a previous paper about it. We call ideology a coherent system of beliefs. So and here I'm going to do the parallel with politics, but it's not only politics. It's just basically having a system and acting according to it. But like if you know Bernie Sanders and Ted Cruz, you probably can imagine the way they are going to vote about something, even if you haven't observed them yet. Right? Yes, because they have a certain view, a certain ideology. They could sometimes deviate from this type, but most of the time they vote according to type. So here we are trying to estimate what the type is for each of these institutional investors. And then, of course, once we have established the type, which depends on the entire history of voting and the similarity with other institutional investors, we can take a step and say, okay, now that I know who falls close to each other, what can I say about the dimension that matters? What separates different types of investors? And so the fact that we don't have any value judgment ex ante is great from the point of view of the statistic. But of course, you need the value judgment ex post. What does it mean that on the first dimension, the two of us are very close to each other and I'm very far from him? What is this underlying dimension? And of course, we can have an opinion. We are going to argue what the dimension is. Someone else could look at the same data and try to argue something else. So this is the idea. Okay, so what do we find? Both in the previous paper and in this one, we find that the first dimension is the dichotomy between being socially or profit-oriented. So we put funds on an horizontal line. Funds that fall on the left are funds that tend to be more socially oriented, more likely to vote in favor of workers, environment, and so on, even governance. The ones that fall on the right are more like value investing type of fund that in their mission, which we check ex post, value minimizing taxes, maximizing returns, doing this type of analysis. On the vertical dimension, north-south, we have a dimension that we interpret as being pro-management or tough with management. And there we can see that the proxy advisors will have a role. Specifically, among the proxy advisors that we consider, Glass-Lewis is very management disciplinarian, and ISS, on the contrary, tends to be more friendly with management. Okay, so what are our, I'm going to tell you the main findings, because then I'm going to dedicate some time to explain the methodology, and then I'm going to go over the results. And this paper is very preliminary, very few discussions and so on, shorter than 99 pages. And so you will see that, and I apologize with part 2, because once you read it, it sounds even more preliminary than me speaking. And so as a result of that, first we very much appreciate your input, and also you will see there are many things that, oh, wow, you could do this, you could do that, so we are in process. Okay, so we analyze all these votes from the fiscal year 2004-2005 till fiscal year 2017-18. Turns out there are 8 million votes. We focus on the Russell 3000 companies. And so if one company is at least once in the Russell 3000, we keep it in the sample. So as a result of that, we end up with 5,323 publicly listed companies and 561 institutional investor families who vote. We have some screening to make sure that what we look at to decrease noise. So first we consider institutions that vote at least on 50 proposals, so that we have some signal from their behavior. We consider proposals that have at least 20 voters. And also we exclude cases in which there was large agreement, either on the yes or the no side. Just because for us, if all of us we agree, then it's pretty difficult to tell whether I'm close to her or close to him. That type of vote is non-informative about our relative positions. So after we exclude all that, what do we find? We find that most mutual fund families actually have stable ideology over time. Despite there have been so many changes in this period, they tend to be more or less like their type doesn't change that much. There are some groups that evolve a little bit, but overall, they stay true to self. And, you know, we could try to open that black box and think about why. Maybe different type of culture hire people that are similar. Maybe there is not much to change. Maybe you change what you say in your statements, but then when you vote, you more or less follow whatever you believed before. But this is at least what we find. There are some exceptions. For example, the socially oriented funds, they are on the left to start with in our sample period, but then they tend to separate out more from the rest. So they tend to specialize on being socially oriented, and they become more assertive in their vote when they do so. Large funds like BlackRock, Vanguard tend to be center-right on the first dimension between socially oriented and profit-oriented. And actually, if anything, they move slightly right over time. So despite there are a lot of statements about ESG and so on, and to be fair, maybe all those statements changed the voting behavior in the last few years that we don't have yet. But up to 2017, 2018, despite the evolution of the statements, there doesn't seem to be an evolution in the voting, actually. And here we are comparing funds to their cohort, so to everybody else that votes at the same time, but also to themselves in the past. So they don't seem to change their position within a certain year, but also compared to themselves in the year before. And I'm going to tell you exactly when I explain the method what is the identifying assumption, and we can discuss whether you believe it or not and what we can do. In this methodology, we also include 3 virtual voters. So these are voters that give a recommendation but don't really vote in practice. So ISS, Glass Lewis, and management give a recommendation. They don't actually vote, but we include them as voters to estimate their relative position toward everybody else. And so on the first dimension, social versus not, ISS tends to be center-left, and it was more actually on the social responsible side in the early years. On the second dimension, tough on management or not, they are quite aligned with management. Glass Lewis is less socially oriented, is more or less in the middle on the first dimension, but it's very tough on management in the second dimension. So if you had to characterize Glass Lewis is very distinctive on the second dimension and very tough on management. And then management, of course, is pro-management, which is not that unexpected. And on the first dimension is money conscious. So they tend to be more profit-oriented, and on the vertical dimension, they tend to be in their favor. Okay, so what is the intuition? So there is a version of this methodology, which is, by the way, not similar, but this methodology was invented in the 80s in this static form, and this is the same methodology that Nat Silver in the New York Times uses to determine the position of the congressmen or the senators and so on. So it's a widely used methodology in political science. The static version puts together this random utility model, a spatial model, and then we have to estimate various things. We have to estimate the position of the investors in the space. We have to estimate the position of the proposals. And we have to estimate a way to tell whether, given a proposal, you are predicted to vote yes or no. And the way they do this is basically by iteration. You keep constant, you estimate the position of the investors just by considering how often they agree with each other. So a very simple measure. Then you keep the investor constant, you estimate the position of the proposals by minimizing errors. Then you reiterate, keep the proposal constant, re-estimate the investors, and you go on till you cannot make any further improvement in the relative positions. So you cannot move anybody on this space and reduce the errors. And there is a loss function, of course, that gives weight to an error, whether it's a small error or a big error, which I'll explain. Okay, let's look at an example. So suppose we have only one dimension. This is like the ESG favorable, and this is the profit-oriented. And so this is the position of the investors. So on one dimension, the investor is a point. This investor has a utility function that is single-peaked and symmetric. Ideally, the investor votes for a proposal that falls exactly on the top, on the point that maximizes their utility. Then, what is a proposal? Well, the proposal is represented by 2 points. What happens in terms of dimension, so social versus profit, if the proposal is rejected? What happens if the proposal is accepted? And, it could be this close, this far, it's 2 points. How is our investor gonna choose? Well, it's gonna compare the utility if the proposal is accepted, its own utility if the proposal is rejected, and in this case, he votes for the proposal because the utility is higher. And this happens for everybody on all the proposals with some noise. Each proposal is also characterized by a midpoint, the blue one. What's the advantage of the midpoint? This is a method that can give you satisfaction, and you can find it interesting after you learn all the method, but it takes a while to figure out all the elements. So the blue point is halfway between the 2 black points. It's the proposal midpoints, and the function of this point is to separate those investors that are predicted to vote no from the investors that are predicted to vote yes. If you take every investor and you do their utility function, anybody whose red points falls on this side will prefer to vote yes. And everybody that falls on this side will prefer to vote no. So we have the expectations, but then, of course, we have reality. And one test of these models is to see how well do they capture reality. Another good aspect of this model is to say, okay, BlackRock or these other investors deviated from their type in this vote. Why? What are the type of votes they deviate the most, and so on. I will stop picking on BlackRock because it's just what comes to mind, but I will vary it a little bit. I say this already. Okay, so one thing that someone could do is to say, well, I'm going to estimate the model that you just told me every year. Every year, all the investors vote on a set of proposals. They are going to be estimated on a space that goes from -1 to +1 on one dimension, same as the other. And then I see how it moves over time. If I do that, though, I always basically, and this is from the actual data, you see as time passes, you are implicitly assuming that the center of these groups is the same over time. So if you do repeated cross-section, this is what you see. But in reality, things could be moving this way or this way. So you need to find a way to connect not only the voters that vote at the same point in time, but also the voters with their previous identity and their future selves. Okay, so this is what this empirical model does. It's sort of more complicated to do than the repeated cross-sections. And the way it works, in 1 minute, since the time is going down, is the following. So in order for the two of us to be comparable, Kathleen and I, we need to be able to vote at least on some subset of proposals at the same time. Problem is that Enrichetta 2023 never votes on the same proposals as Enrichetta 2016. It's impossible, right? So how do you compare me over time if you never see me voting on any same proposal? So the underlying assumption is this method is to say the proposals are estimated in a static way, meaning if my ideology was constant, then if Enrichetta 2013 could walk back in time and vote on the 2016 proposal, I would have voted the same way as Enrichetta 2016. So this is the assumption that you need to believe. If you believe this, then you can compare things over time as well. But if there is some selection on the type of proposal or the leaning of the proposals that get presented in different years, then this assumption could break down. So one thing that we need to know, I don't know the discussion, but one thing that we would need to do more is to analyze what type of proposals get presented year after year and see whether this assumption that, more or less is the same, is valid. There are definitely type of proposals like director and all, so the typology are constant over time. But it's definitely true that certain proposals become more popular in certain years. So this is something that we need to do. So if you believe that, then you have a common space to evaluate everybody, both in a cross-section and over time, and you can do more things, but you can do this. In the 2-3 minutes that probably I have left, let me tell you the results. So this is management over time. The gray is the Glass-Lewis, and the orange is ISS. And this is the first dimension. You can see that the management tends to be profit-oriented. ISS tends to be more social, but less so over time. And Glass-Lewis tends to be indifferent on the first dimension. If you look at the second dimension, the vertical one, then you see Glass-Lewis being tough on management, while you see ISS and management more or less overlapping. So ISS is management friendly and management is management friendly. So this is what we find. Here, what we do is that we separate all the groups in groups that start in the center and deviate, start at the extreme and keep going extreme, and so on. We quantify the number of funds that are in each group, and we try to see how many of them are there. And we do this analysis both equally weighting the funds, but also weighted by the number of shares and the funds under management. Indeed, I think the quick takeaway here is that if you consider the fact that certain large institutional investors have been gaining assets under management compared to everybody else, the groups overall had moved slightly to the right, because more money came to the center-right groups than everybody else. So this is the groups. This is the median, and all the median investors, how it moves over time. So you see that it goes slightly to the slightly up, meaning to the right, both if you value weight or equal weight. let's see. Let's do one other thing, which is the proposal, and then I conclude. So if in a one dimension a proposal is 2 points and a midpoint, in a 2 dimension a proposal is what happens if the proposal loses, what happens if it passes, and then there is a line that is perpendicular to the line that unites these 2 things. So this is the line that separates those that are predicted to vote yes from those that are predicted to vote no. So for any single proposal, you can look at the ideology of the investors, see if they are a yes, see if they are a no, and you can also check whether they actually went the way you expected. We have 2 parameters to see. You know what, let me tell you this. So how did we figure out that the first dimension was ESG versus profit and the vertical dimensions was tough on management versus not? Well, the way you figure it out is to say, okay, first is the identity of the funds that fall on one side versus the other, their mission, their features. But also is the proposals that happen to be more divisive? Like that creates the most disagreement among investors. Those are the proposals. So based on the topics of those proposals, there are some proposals that everybody agrees on. Those are not the proposals that tell you what dimension it is. The proposals that tell you the dimension are the proposals that even if one moves a little, the outcome is going to change. Those are the most debated proposals. And so there are 2 parameters that helps you determine that, which I invite you to read the paper, are the alpha and the beta. But basically, this is a proposal that is, if something changes in the positions of the investors, we go from a no to a yes pretty quickly. This is a proposal that it takes a lot of changes to go up and go for a yes. This is a totally uninformative proposal. You can look at all the positions of the investors on the line, and you still have a 50-50 probability of getting a yes or a no is the outcome. So this is a non-informative proposal. So you do that for both dimensions, and you find your results. Okay, so did the proposal change over time? Well, say on pay became more popular, for sure, and social proposals become more popular very recently. So our idea of checking whether the space of proposal is common will focus on these two areas. Here, one other thing that we did was what are the features of company whose investor pool is more on the right versus the left. So companies that tend to have higher ROA, size, market cap, higher institutional ownership are also companies that have institutional investors that tend to be more to the left, more socially oriented than everybody else. I think we're more or less out of time, probably more than less. So I look forward to Pat's comments. Thank you.
Thank you for inviting me to discuss the paper. And it's always great to discuss a paper that is a bit earlier in the process. No, it's much easier to, I think, actually have impact. So I'm really happy to discuss the paper on the stage. And so essentially, the paper is attempting to examine the evolution of the ideology of institutional investors. And so the main results so far are that there is sort of 2 dimensions along which one can characterize the preferences of institutions. The first is sort of a left-right divide on social issues. The second is sort of a more or less manager-oriented view of governance. The authors find that the largest investors have very stable ideology over the sample, and for other investors, this isn't quite as clear. And so I'm going to talk about some thoughts on why this might be. And so the discussion is going to focus first on some differences I want to highlight on the functioning of government and the role of voting in a legislative context versus the role of voting in a corporate governance context. And I think there are some key differences that the authors might want to lean into, which I think are going to put a few caveats potentially on sort of this particular application of methodology. The second is in particular the issue of strategic voting. And I'm going to lean on some of the literature on governance, in particular on shareholder votes, for this, and then some suggestions for future analysis, which I think would be interesting. But to echo Enrichetta's thoughts, there's a lot that can be done in this space, and so these are some suggestions of probably many that you're going to get. Right, and so just before I jump into this, I'm going to actually spend a few minutes talking about the more traditional uses of these measures. And so what I'm plotting here is the first ideology score as applied to politicians measured over the last congressional cycle. Right, and so this is the first dimension. I'm going to show you the second dimension in a second. And this is typically viewed as the left-right Republican Democrat view of the world. Right, so we've got Democrats are in green, Republicans are in red. Blue, Democrats are in blue, Republicans are in red. This, so if we look at, Jayapal is, for those who might not know, chair of the Democratic Progressive Committee caucus. Jared Golden is chair of the Conservative Democratic Blue Dog Caucus. AOC is somewhere in between. Pelosi is somewhere in between. If you look on the right, on sort of the Republican side, Stefanik is number 4 in leadership currently. McCarthy is the current speaker, Scalise is the whip, and Marjorie Taylor Greene is, as we know, one of the more extreme members of the Republican caucus, right? So this is sort of what the first dimension looks like. Now, if we look at the second dimension, we get something a bit more odd. And so this is sort of a well-known result in the political science literature that the second dimension, which I'm going to show you in a minute, actually used to be very, very discriminant in assigning ideology, has become a lot harder to interpret. Right, and so this is, a question about the methodology. It's good for identifying preferences. It's not always clear exactly what these preferences mean. I mean, here we've got AOC and Marjorie Taylor Greene essentially quite close, and yet Golden is on the other side. This isn't quite left-right ideology itself. We don't quite know what this is today. Now, if we had gone back in time and we look at, let's say, the 88th Congress, and for context, this is the Congress in which civil rights legislation was passed, which is why I have the quote from LBJ. This is back in the time period when you had a lot more ideological diversity across different geographies. So if we sort of look at the first and the second dimension, they actually look a lot more similar to the first dimension now, right? So there's been sort of an evolution of this over time in the political science sector. If you were to even go back further into like the 20s, this essentially would be completely bimodal, and this would essentially be one big mass. Right, and so why am I saying this? I'm saying that it's understanding what these peaks are and how they evolve is really complicated. But the idea is still there is definitely content in what comes out of these notions. Essentially, if you really to have looked into this second dimension historically was basically a preference for segregation or not, right? And sort of as society has evolved, these dimensions have evolved, and the question is sort of what exactly is driving what. And I think the same types of questions are going to come up, or do come up, when one reads Enrichetta's paper, right? And so to come back to actually the last point that Enrichetta left off on, how do we think about these ideal points? Well, what I'm actually presenting here is a panel from one of our tables, which gives some information about what's giving this estimation juice, in some sense, right? And so the first dimension represents social attitudes. We can see that because the first dimension, this is essentially saying the proportion of different proposal types that's informing the estimation for the first and second dimensions. And what we see here is essentially that governance, proxy access, and social issues are adding a lot of value or having a lot of weight on the calculation of the first dimension, whereas compensation and essentially corporate policy is having a lot of weight in the second dimension. And so, again, echoing, I think, some Enrichetta's next steps, I also think it's really important to understand what is the changing frequencies of vote topics have to do with this. And a second point that I think the authors really will want to consider is how does the entry and exit of some of these smaller funds matter, right? Because if we, and are there sort of latent factors that are driving both, right? So this is sort of a matching model. We could very easily get this idea that there are trends in the macroeconomy that are leading to certain types of proposals. Funds are being created to cater to these latent trends or these new markets, and that's sort of what is driving some of this ideology, right? And I think both stories are interesting, right? It doesn't we don't know anything about this space really at all, at least in the financial economics context. But I think sort of figuring out a model of selection versus something like treatment, even if it's not treatment per se, and sort of having a structured framework to speak about this is going to be helpful. So now moving on to the way we think about voting. I think there's a fundamental difference in voting in a legislature versus voting in a corporate governance context, right? So essentially what a legislature does, in particular in the US, they make laws, right? They oversee some things, they oversee regulators, but that's sort of a different function. What they do is they write and they pass laws. And so voting is literally their job, or at least it should be. Now, corporate governance, we know, is much more complex, right? So I'm going to present now a table of what seems to matter to institutional investors as surveyed by McCary et al. And there are a lot of potential ways that funds engage with management, right? And so what this means is, so this is voting is one action among many that funds take. And so it becomes a lot harder to say that this is a pure application of preference if preference can span voice, exit, private negotiation, public shaming, right? What we observe in the context of voting is one very particular mechanism in a much broader question of how to engage with firms. And so this means it becomes harder to say this is purely preferences when the set of things that actually come up to vote are probably conditioning on a variety of other strategic actions, right? And so this is why I think a discussion of how this relates to and is different from government is going to be really helpful for the paper. Right, and so sort of a related thought here is one assumption that is working in the background and is really important is in order to interpret these as literal preferences in a single peaked fashion among several dimensions is that voting has to be sincere, right? And so my question is, how strong is this assumption, right? And again, so if governance actions are a balance of voice versus exit, it seems hard to assume that what we observe in a vote is purely ideologically driven, in particular in a repeated game. Because one could very well be, for example, upset with management and going to publicly vote in a different way than you might have privately done if some negotiation broke down, right? If there are other dimensions along which you are trying to negotiate, and some are observable, some are not observable, it's not clear that what funds are going to actually vote on is truly sincere for their sort of first best preference. In particular, if firms can leave, right? So if some firms are more easily able to exit, the set of funds that are left to vote, again, there must be information in who stays and who doesn't stay, and this is probably going to inform preferences as well. And so separately, there's research that, again, highlights that these votes are really high stakes, and there are huge incentives to manipulate. And so I sort of want to point out in particular a recent paper by Bach and Metzger, who argue that, well, so Foss and Zhang first show that managers are more likely to exercise options to increase their voting power. Taking this result as given, Bach and Metzger show that firms can see essentially in real time how votes are going, and they can act accordingly. In particular, they use option grants to strategically manipulate their own vote share so as to achieve particular outcomes. They also show this is particularly true for votes that are close. And from a mechanical point of view, close votes are oftentimes those that are the most discriminatory for first and second types of ideal point estimation, right? And so in particular, they conclude their paper with quite a strong statement that they provide original evidence that voting systems can be systematically manipulated by management to obtain results in their favor. And moreover, this challenges the view that corporate elections accurately aggregate preferences of voters. And so, again, and so this is, I think, a concern for studies that look at RDDs for close elections in these contexts. But I think this, again, is some research that's worth sort of looking at to, again, see what it is that we can take from political science and apply to governance. I think this is quite an important point. And so sort of, finally, I just have a couple of thoughts. The first is, how does ideology relate to fund characteristics? This is an area for future future research, does this correlate with horizon? To what extent does active or passiveness or sort of pseudo-passiveness in sort of wonky ETF strategies associate with etiology? Does this really correlate systematically with explicitly pro-social marketing materials? On the firm side, and Enrichetta didn't have a chance to show this, but she looks already at the extent to which compensation is associated with the weighted average etiology score at a given point in time. I would encourage the authors to sort of look at a few other characteristics, in particular their CSR scores, maybe their charitable contributions, their pollution or exactly environmental outcomes, employee satisfaction, financial fraud. There are a lot of things that we could do. And I don't think you should try and sort out causality. That's not something that I think you would ever be able to do for most of this. But I think, again, showing in a sort of, even an association on this front would, I think, also help to validate this measure in certain useful ways. And so let me just conclude by saying I think this is a thought-provoking paper using very sophisticated methodology to propose a new notion of fund preferences and etiology. And my suggestions are to think about voting in a legislative context versus a governance context and how they might be quite different in some respects. And to think about the idea of ideal point estimation in a world with potential strategic voting and looking at whether or not etiology manifests in other observables. So thank you.
Thank you, Pat. So Enrichetta.
I gave away my microphone. Works? Yeah. So thank you so much for the excellent comments. We will ask you the slides, and I wrote down a lot of them. There are a lot of, some of the things we are thinking about, some of the things were new, so thanks a lot. I'm going to quickly respond to a few points. So first and second dimension and how they evolve over time. Definitely this method in spirit is similar to a factor decomposition. So the first dimension is always more important, the second dimension is always less important and so less stable. I have to say that we also notice that there is some sort of evolution in issues. Controversial issues start at first dimension, and when they become established, they become second dimensions. So for example, compensation was a first dimension issue early in the sample, but then when say on pay becomes mainstream and so on, it evolves and becomes a second dimension. It's not as divisive, like diverging. I think it's as before, but there are other things that come up. Selection, yes, that's both on the proposal side and the entry-exit funds, they are related, and we are thinking about ways, if possible, to address those or at least analyze it. Exit versus voice. So this is definitely only one of the many actions that they can take. One thing that we thought when we started this project is that there would be way less overlap in the stock portfolios of these investors. But in reality, most investors invest in the market and then they have tilts. So there is actually much more overlap than we thought. A lot of investors vote on pretty many similar things. The passive investors cannot exit, so they have to vote. They may have used voice or engagement or tilt. So, but there is a good question of asking, so are voting and engagement or exit complementary? So they reveal the same? I mean, if there is a type, how does this type manifest itself in these two actions? In a complementary way or in a substitute way? Sincere voting and reveal preferences. And then, I mean, there are other comments. But so one thing about the sincere voting is definitely true that in this method, you need to vote sincerely with a little bit of noise, but not too much noise. These are only revealed preferences. We don't know what you thought. We just know what you saw. But what you voted, but it's important to know what you voted, because you might, want to vote Trump or vote against him, but then if you go and actually vote him, there is a difference that if you don't. We have a way in the model to estimate that. So if the votes are just noise, then the model breaks down. And then when we do the statistics to compare it to complete random noise or always voting yes, because most of the time the vote is yes, the model should perform worse. So we have some methodologies. Also, and this is the last thing I'm going to say, the ordering and the position on a certain dimension also measures how costly it is for you to go against your type on a given vote. So if the blue dot is right here in the middle, and I'm very close to the blue dot, I could vote yes, I could vote no, it doesn't really matter. If I'm very far away, then for me it's very costly to go against my own nature and go on the jump on the other side of the blue dot. So one other way that we did it in the first paper, we haven't done it here yet, is to see when there is a jump, is it a big jump on the other side or a small noise? But yeah, these are all well-taken things that will make us think and work for quite a long time. Thank you.
So any more questions here for Enrichetta? Oh, okay.
Thank you. Very interesting. Because the question is influenced by Doron's paper that I discussed, but I'm wondering if it's feasible to relate preferences of institutional investors and also how they change over time to their ownership data, how they deviate from the benchmarks. And that could inform, I'm just curious, some descriptive analysis would even that be very interesting.
Yeah, that's a very good point. And actually, we have started working on that. So you can apply the same methodology to yes, I own it, no, I don't own it. And you can also apply the methodology, how many of my dollars, what proportion of my funds goes into a certain companies versus another. So we are still figuring out all the details and how to best do it, but that's exactly the direction we are going to go. Yes, thank you.
Any other questions?
There was a point mentioned by Pat, I think, about the second dimension that showed Marjorie Taylor Greene being very close to AOC. I think this is not necessarily a problem because, as we know, political spectrum is not a line anymore. On some issues, the far left and far right actually agree. If you look at international trade, Bernie Sanders and Steve Bannon agree. Both don't like, the tariffs. So this is not necessarily, as long as you can identify what really this is measuring, it's okay. And I don't know if Pat agrees with me. It's okay that these are not classical far right, far left, being far from each other. They could be actually close on some issues.